Hey traders, this is Blake Morrow with Trader Summit, and I have Jim Welsh with Macro Tides joining us today, and he's going to break down all the market moves that we've seen this week. Jim, what a wild week! We had the euro dip below parity. We had the S&P dip below that key 3740 level that you were looking at last week.
Yep.
But
Yep.
bounce, I know you got a lot to talk about. We've had
Yep.
a lot of comments from the Fed speakers. We've gotten a lot of data this week. What are your thoughts right now?
Okay. Well, basically, about 2 weeks or so ago, Blake, we had a bunch of economic reports that were on the soft side, and people began to think. When I say people, I mean Wall Street. Maybe the Fed will only do 50 basis points in July. All right, and my view back then was no, they're going to do 75. Then the CPI report and the producer price report yesterday. Oh, the Fed's going to do 100, and then they're going to do 75. No, they're not. They're going 75 in July, and I still think that there is the possibility, or at least it will be discussed at the Fed meeting, that they 50 instead of 75. And there's a bunch of reasons why I've kind of been constant in terms of this view. And the main one is that the Fed governors and presidents kept saying for probably 6 weeks, we got to get the Fed funds rate up to the neutral level. Powell has said 2.5, and if they 75, they're going to be at 2.25, 2.5. What I've discussed in the macro tides as well as the weekly technical review is that financial conditions have tightened more than the Fed has tightened. In other words, yields, rates, the spreads, the dollar strength, weakness in the stock market, components of financial conditions.
Do you want me to? Should I bring up that chart, Jim?
Yeah. So before we leave this, okay. So, perfect. We should do that. Good point. So this shows, you can see the bottom, and I think we looked at this chart like 2 weeks ago because I've been talking about this. On that, the bottom axis means from the first rate hike. So this is about 2-3 weeks old chart, and you can see in the 13 weeks from mid-March to mid-June, the financial conditions had tightened more and obviously more rapidly than in the prior 7 hiking regimes. So what I basically have been saying is normally everyone thinks, all right, takes 6 to 12 months for changes in monetary policy to have an impact on the economy. Well, given rapidity and how quickly financial conditions have tightened, it only seems reasonable then that the lag time will be less. Things have tightened more quickly and more significantly. One of the reasons why I believe the Fed is going to start thinking about decreasing the magnitude of rate increases. I'll use an analogy. You're in an airplane at 30,000 feet. You're getting ready to land. Well, the rate of descent from 30,000 to 5,000 feet is a lot quicker than it is from 3,000 to the ground. Again, the Fed wants to achieve a soft landing. At some point in time, they're going to shift from 75 to 50, then 25. They're still raising rates, but they're doing it in a much more measured way. I think there's the potential that as we get to September, that's going to be on the table. The Fed's going to have a lot of data. They're going to have 2 more employment reports, 2 more CPI reports. We're going to see some of the bleed through from the drop in commodity prices, the gasoline prices. It's going to start to show up in the data points, and we're going to see inflation soften. So I think those are all reasons why the Fed is likely downshift. There's another consideration. 98% of the time, maybe 99% of the time, the Fed is totally focused on U.S. conditions in terms of monetary policy. But you get to those, brief windows of time where they can't really ignore what's going on globally. Obviously, what's going on in Europe with energy prices, they're going to have a recession one way or the other. It's just a question of how deep. That's a factor. But the other thing is financial conditions are tightening, not just in the U.S., but globally, and especially in emerging markets. So if you want to look at the next chart, which shows financial conditions in emerging markets, and we can see relative to the U.S., which is in the purple, in Latin America, way tighter. Asia, quite a bit tighter. And part of this, Blake, is in the emerging markets, they started to raise rates last year. So they were ahead of the game. But the point is, as the dollar strengthens and emerging market currencies decline, when they start buying food or energy, if they don't have it, and it's going to cost them more. So we're actually exporting now inflation to a lot of countries who buy raw materials based in dollars. And then their central banks are responding to it. This domino effect that's beginning to happen in terms of the ripples that are coming from the dollar strengthening, the emerging market, the yen, euro all dropping significantly against the dollar, and implications for monetary policy in those countries. The other thing is a huge squeeze. If I produce goods and services in my country, and I'm an emerging market country, the revenue is in that country's currency for the most part. You know, if I have a small amount of exports, not that big of a deal. But I got to pay, if I have a dollar denominated loan and my currency went down 10%, so now I've got a depreciated currency based on I'm getting my sales in the domestic economy, but my service expense in terms of servicing that debt are up 10%. So you get a real squeeze on dollar denominated debt, and there's a 17% of foreign debt is dollar denominated in emerging markets. So my point being is, at some point in time, the Fed approach additional rate hikes has to kind of be looking off to the side a little bit and saying, okay, these are the reasons in the US, maybe we should downshift. Maybe the fifth or sixth reason is, hey, potentially we got some global reasons as well. And, you know, that just gets added to the reasons of why downshifting makes sense. So I think the markets have gotten it wrong. You know, in terms of 2 weeks ago, it was, oh, they're maybe only going to do 50 in July. Oh, now they're going to do 100, they're going to do 75. And this, a lot of these people have no direct experience and clear understanding of Fed's forward guidance.
Well, what we are seeing is we're seeing the Fed really kind of, especially the last couple of sessions, they've really trying to walk back expectations from the market.
Yep.
So we are now seeing that from the Fed. So Jim, what does that mean for us trading it? It all makes sense, and I understand exactly what you're saying. But you know, what does that mean for the S&P? Like, what do we do here? Because
why don't we look at the S&P chart, and lo and behold, Blake magically makes it appear. All right. So as you noted in the lead-in this morning, hey, that 3740, I mean, you know, 3739 to be precise, was important. Yesterday we dipped underneath it, but obviously closed well above it. So I've been looking at this pattern and expecting that we could see a rally above 3948, up over 4,000. And how I get there is the rally from mid-June at 3637 went up 309 points to 3948. This is a down, up, down for a B wave down to yesterday's low at 3722. If a C wave is equal, it gets you to 4,031. At a minimum, this pattern suggests the S&P should get above 3946. And I obviously this news now forward guidance. A couple of weeks ago, when the street was starting to talk, well, maybe they'll only go 50. Hey, a few governors came out and presidents said, no, I'm in favor of 75. In other words, they didn't want the market to start thinking they might back off. Waller came back and said, no, I'm not going in favor of 1%. I'm in favor of 75. And so to me, what they're trying to do is provide guidance. If you will, investors stay in the middle lane. No, we're not going 50. We're not doing 100. We're doing 75. At some point in time, as we go past the July meeting, Blake, some of their language is going to change. And I think it'll be things like, we've made a lot of progress in getting the funds rate up to neutral. Got to see how the impact of, type of financial conditions have on the economy. They're going to telegraph that they're going to debate whether it's going to be 75 or 50 as we get deeper into August, obviously, or the first week or so of September. That's coming. But I think in the near term, we've got a rally above 39.46, potentially up to over 4,000. And then I think there's another decline coming because the Fed isn't going to telegraph that stuff yet. It's not time yet. They need to see much more evidence that inflation's coming. They want to see labor market tightness decrease. You know, Powell has repeatedly said and noted the ratio between job openings and unemployment rate. At 1.9, it's unbelievably tight going back decades. So they're going to want to see that kind of evidence showing that things are loosening up in the labor market. To take time. And so that's why I think, yeah, we get this pop and then back to people like, oh, okay. And earnings are going to get marked down some more. And
all right. Go ahead. I'm sorry.
No, and dollar strength is going to be part of the reason.
Okay, so we have the TLT here, and so how are you feeling about the bond market? You still feel that bonds are going to move higher?
Yeah, still constructive. As you see that arrow in mid June when TLT was trading about 110.25. A special update to subscribers saying I think it's time to buy TLT. I think move up towards 119, potentially 121. Minimum expectation. And potentially, we're going to see a rally begin that corrects the decline from 155, that high, in the low this year at 108. So 2, 3, 4, 5. That's, you can see the red 4 and the red 5. That's okay. That's from 155. We completed a 5-wave decline, and we had a significant rally that retraces 38% to 50% of a 47-point decline. 50% of that, TLT is going to 130. So to me, it was a good place to buy. What we're seeing is we're making higher highs and lows. For months, it was the exact opposite. You know, so I still like TLT. Needs, you know, keep that stair step. So should it stay above 112.05? Yeah, I would even put up to that low the other day, which was, I can't remember exactly what that low was. It was just over 113, I think. But I think the odds are, and the reason why, Blake, is I said, hey, the economy is going to show more signs of slowing, and he's going to benefit from that.
All right.
And
well,
so far that's been playing out.
That has been. And so here's one that, I mean, you brought up gold, and gold looks, I mean, it looks not so good.
Yeah.
And I thought I had gold here, but I don't. Let me see if I can pull up the chart really quick. Just bear with me.
Yeah. Well, I'll do some verbalin. Okay.
Yep, do.
You're right. It doesn't look good. Sentiment is pretty negative on gold. I mean, why should it be anything but negative given how it's performed? You know, in August 2070, gold, August 2020, gold peaked at 2070. And you can see that kind of in the middle of that chart, right? Well, inflation was 1.5%. Well, 9%, and gold is 1,700, you know? So, you know, you wouldn't expect gold to bottom on a high print of inflation. You would expect the opposite, all right? But here's why I think it's time to buy gold. From that high in August 2070, it's very choppy, down to 1670, call it 1680, because, you know, plus or minus, right? And that was March of 21. Then you can see a very big up, then a pull, very choppy move up to the in March of this year at 2066. I think that's a B wave. So you had an A down, B up. Now we should get a C wave. It should be 1, 2, 3, 4, 5. From the high at 2066, you can kind of see 1, 2 up to 2000, 3 down to below 1800, 4 up to 1867, and now wave 5. I think we're really close to a fairly important low. It's time to buy gold. Now, I would go 50%. I wouldn't go whole hog, you know, because the chart does look ugly. And we need to see, you know, confirmation that things have reversed. This is a weekly chart. You can see the RSI is down to at 30, 31, or whatever that number is. Very sold. You can look at the last couple times you got down near 30. It was an opportunity. So for all these reasons, Blake, I think gold is going to have a rally. And if I'm right about monetary policy and people being wrong about just, you know, they're looking for the Fed to raise funds rate 175 basis points between now and the end of September. I don't think it's going to happen. That would be helpful. There's another thing that could be helpful and that gets us to the euro chart.
Well, now the euro we did break parity, and you know, we have some big stuff coming up on the horizon with this Nord Stream. So I'm interested to hear what your thoughts are on euro.
When we had a conversation on July 7th, is the euro going to break below par? And I said yes. I think if you look at it, high near 108, 1 down, 2 up. Obviously, this decline to par is wave 3. There's a bounce here somewhere, and then I think there's a good chance of 1 more drop below par before you can count 5 down, and that completes a decline that goes back months. All right, it's obviously oversold, as the bottom panel shows. RSI well below 30, and so forth. Now, the decline from 106 and change started June 23rd, when Gazprom said, "Yeah, we're cutting the supply of gas we're providing by 60%." That's what led to, you know, the euro falling apart, because it has severe economic potential if Nord Stream doesn't resume. Now, they closed it down on July 11th completely for maintenance. That was well advertised. Reopening it on July 23rd. So it really comes down to, will Gazprom, namely Putin, open up the pipeline? I think they're going to at least some extent, and that should give the euro a really good lift. So from a trading standpoint, I think being long the euro near par makes sense. It may dip to 98.50. It may dip to 99, but at the very end of something. So if the euro gets a pop out of that news that, okay, we are going to reopen the Nord Stream, and the euro rallies back up to at least 103.50, that was where it broke down from. The dollar obviously comes off. That's helpful for gold. So I think buying the euro here for a rally back up to at least 103.50, and in reality, Blake, my bet would be that we'll see the euro back at 107 time over the next 6 months.
Wow, that would be
more of lesser degree. So that's why I think, hey, these are the positions you got to kind of be looking for, and not micromanage them. Most of the time, you kind of have to do that, maybe in the currency market. But the important intermediate turning points, I think you got to say, okay, some of the money I'm going to do tactically and play, you know, the swings, but some money should be positioned for at least 103.50, and as I think potentially 107 would be in the cards. So you could expect a rally up to 103, then a pullback because that's resistance, you know, and then go up. So a lot's going to happen in the next 60 days.
All right. Well, it's going to be an exciting 60 days. And Jim, I love how you put the picture for us together each and every week. So if I'm listening at home and I'm just learning who you are, how do I follow your work?
Macrotides.com. To find more about my investment letters, and if you send an email to Jim Welsh Macro at Gmail, I'll send you a recent sample, so you can, you know, actually look at it. You know.
That's great, Jim. Well, we appreciate
it's Friday, and I'm ready for a weekend.
Yeah. Well, you enjoy your weekend, and we are excited and so thankful to have you here every week. So have a great day and have a great weekend. We'll talk to you next Friday.
You got it, Blake. Thanks so much.
Thank you. Bye-bye. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.